It feels like every week, home prices in the housing market break a new record because home prices keep going up and housing demand keeps skyrocketing and the inventory of homes available for sale are still artificially low. What's up everybody, I am Jaspreet Singh from theminorityMindset.com where money minds rethink rich. Homes are getting expensive, fast, and it's really getting kind of scary. Let's look at some numbers. If we go back in time to 1970, the median home price in 1970 was just $17,000 and the median household income back in 1970 was right around $8,700. So that means that an average person could go out and buy a home for right around 2 times their annual salary. If we fast forward a little bit to the year 1995, where my 90s babies at, in the year 1995, the average home cost $124,000. Quite a big jump, but wages also went up too. The median household income back in 1995 was $35,000 a year. Now the interesting thing here is that by the year 1995, if you wanted to go out and buy a home, it would cost you about 3.6 times your household income. And now let's fast forward all the way to the year 2021, where the median home costs $341,000 and wages have also gone up too. The median household income in the year 2021 is $80,000 a year. But the thing that makes this very interesting is now if you want to go out to buy a home, it's going to cost you about 4.2 times your annual household income. So you can start to see why housing has become less affordable over the years, because on one hand, yes, home prices have gone up and wages have also gone up too, but home prices have gone up faster than wages. That's why you can start to see this multiple start to grow, because the multiple of wages to home prices have gone up too, which means it's more expensive for you to go out and buy a home, adjusting for inflation. But we're not done yet, because the thing that's even more interesting now than before is that now we have a lot of 2-income households. This is the median household income. Back in 1970, you didn't have a lot of 2 household incomes. Most of the households were just 1 income. You had 1 person going to work. Nowadays, we have 2 people going to work, 2 income streams, which is how we got to this $80,000 figure. The median income in the United States right now at the time I'm recording this video is $55,000. That means there's a good chance that you have one spouse making more than the other spouse, and at $55,000 a year, the multiple to the median home price is 6.5 times. So now, this is where you can really start to see the acceleration in home prices, because yeah, maybe here you've seen home prices kind of accelerate, but this is really comparing apples to apples, because in 1970, you only had 1 person earning for the household. Now you got 2. That's why in this video, I want to go over why home prices are going up and what you need to know, that way you can be smart with your money. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. And by the way, if you haven't already seen our 1 million subscriber special video, I'll put that link for you in the description below. And by the way, I do want to let you know that we have just announced the winners for our $10,000 giveaway for stock market gift cards from a 1 million special subscriber video. If you haven't seen the video, I will link that for you in the description below, and you might want to check your comments to see if you were one of the people that won $500 in free stock market gift cards. There's a lot of different reasons for why home prices haven't gone up, but the most obvious and the easiest to understand reason is that the cost of building a home has been going up too. A general rule of thumb is that a real estate developer is trying to get a 20% return on their money, which means if they can build a home for $100,000, they will want to sell it for at least $120,000. But what's happening right now is that the price of everything from lumber to paint, everything to build a home has been skyrocketing, and on top of that, the cost of labor for people to build a home has been going up too. I mean, if you drive by any busy area right now, chances are you're going to see sign after sign after sign of businesses saying, come in and apply now, get a free $1,000 bonus if you get accepted for this job, or get a free $50 gift card if you apply for the job. You don't even have to get accepted, you get a $50 gift card just for applying. And the reason why we're seeing that right now is because there's a lot of businesses that need labor. And now in order for them to compete, because businesses need work, they're having to pay people more. And so now, if you are a real estate development company and you need to hire construction workers to build a home and people don't want to work or they're not working and you got to incentivize people to work, you're going to have to pay them more money, which means you're going to have a higher cost to build a home. So now the labor side, you have a lot of people that don't want to work or are not working, and so development companies are having to pay more money to the laborers to build a home. On top of that, they're having to pay a higher cost of materials because of supply chain issues and a whole bunch of issues going on right now. And so you've seen things like the price of lumber, wood, double in the last year. And so it costs a lot more money now to build a home than it did before. So if a few years ago I could build a home for $100,000, I might be okay selling it for $120,000. But now, in order for me to build that home, I have to spend $130,000. So this is before. If I have to spend $130,000 to build this home right now, and now I'll put on my 20% margin on top of that, that means I'm going to have to sell this home for at least $156,000 for it to make sense for me. Now, all of a sudden, if you want to go out and buy a home, it's going to cost you more money, because if you want to build your own home, it's going to be more expensive. You're going to have to pay more money for parts, you're going to have to pay more money for labor, and now it's going to cost you more money to buy a home than it did before. But even if you don't want to build your own home, if you own a home in a neighborhood and you start to see these new homes that are selling for way more than what your home was worth before, now you're going to say, hey, my home I thought was worth $110,000 or $120,000, but these homes right down the street are selling for $150,000 and $160,000. Maybe I can sell my home for more money, because homes right down the street are selling for way more money. And so now, because these homes are being sold for way more, people are selling their homes, which are not brand new constructions, for more money as well. Plus, it's making it more expensive for people to renovate homes. So if someone's renovating a home either for a flip because they want to sell this home at a profit, or because they want to live in the home themselves, it's going to cost more money for them to renovate the home, and that's being factored into the price here. But that's just one part of the equation, because the second part of the equation is we have a really skewed supply and demand system out there, because right now we don't have a huge supply of homes available for sale. It's taking companies more time to build a home, which is keeping the inventory of homes available for sale lower, and a lot of people are not selling their homes. Maybe because they're in forbearance, maybe because they don't want to deal with this pandemic. Whatever the reason is, people are not selling their homes as much, and you don't have people being foreclosed on because of the foreclosure moratorium. So you have an artificially low supply of homes available for sale, and you also have a ton of people. You have a ton of people that want to go out and buy a home because they want a new home to live in. Well, there's a few reasons why people have been buying homes right now. One of the reasons is just because of this pandemic. People, for the first time in history, have been able to work from home. And now they're like, well, my company is letting me choose if I want to go back into the office or not. And so if I'm going to be working from home all the time, I might as well upgrade my home, have a nicer home, because I'm going to be spending more time there. And I should get a home that has an office, or at least a room for me to work in. That way I have kind of my own private space. And so people have been moving away from the city, or even if they're already in the suburbs, they've been moving to new homes because they want a home with a little bit more space, with a yard. That way they can spend more time there, and that way they have an office where they can work. And save a lot of people, just because of this economic shift, because of the pandemic, have been going out to buy a home because they want to get a new home that fits their new lifestyle. The second reason you've been seeing more and more people go out to buy a home is because of, well, FOMO, fear of missing out. It's that emotion, because maybe you've thought about buying a home a year ago, or maybe a couple years ago, and this thought has been in your mind, and now all of a sudden you see home prices going up like this, and you're telling yourself, oh my god, I don't know how long this is going to last, so let's go out and buy a home right now before home prices get even more expensive. And so now you're talking to your spouse, you're rushing, and you're trying to just go out and buy a home so you can capitalize on this housing market and own a home before home prices go up even more. You see this happen in every asset class, from real estate to stocks to cryptocurrency. Anytime you see an asset class start to go up like this, people get excited and they don't want to miss out, and then they kind of go in and they buy, even if they don't necessarily need to buy or want to buy. They just don't want to miss out, and so they start to come in and they buy. And the third major reason why you've been seeing a massive demand to go out and buy a home is because interest rates are dirt cheap. People have been going out and buying new homes and refinancing their current homes and locking in a fixed rate mortgage for 30 years at less than a 3% annual interest rate. This money is very cheap that you're able to borrow and use to go out and buy a home or refinance on the home that you do have. We're at a point right now where mortgage rates are at rock bottom. And the only real direction where mortgage rates can go is up, because mortgage rates are already so low. And so people have been trying to capitalize on these low mortgage rates by borrowing money either to go out and buy a home or to use this money to refinance on their mortgage. Now, that's not a bad thing, assuming that you can afford the home that you're buying and assuming that you're refinancing your home the right way that's going to build you wealth, not in a way where you're just going deeper and deeper in debt that where you're just going to make your bank richer. I mean, it is still one of the best times in history to be borrowing money against a home just because mortgage rates are so cheap. And for people that already own a home, these low mortgage rates are almost like free money, because now you can refinance out of the mortgage that you have right now and get a new lower interest rate mortgage on the exact same loan that you have. That way now you can borrow the same amount of money that you had before and just pay less money in interest because borrowing money became cheaper. Now, if you do decide to go out and borrow money to buy a home, or if you want to refinance out on your mortgage, just make sure you shop around, because some lenders are going to charge you a whole lot less than other lenders for the exact same loan. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage or refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. The process is pretty simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use. Checking pre-qualified rates does not affect your credit score, and it only takes a few minutes to do that. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that with Credible in the description below. Interest rates are really weird because the Federal Reserve Bank cuts interest rates when we're in a recession to help stimulate the economy. And so right now, we're kind of in a weird phase in our economy because everybody says that our economy is recovering, but at the same time, our economy isn't actually recovering because our economy is still relying on a lot of free money from the government in the form of bailouts and in the form of unemployment checks and in the form of stimulus. And so this free money is still out there, and this free money is subsidizing our economy. And so while everybody says our economy is recovering, we still have a lot of people that don't have jobs because people are benefiting from the unemployment programs and the stimulus programs that are out there. At the same time, the Federal Reserve Bank has tried raising interest rates slowly because the Federal Reserve Bank does want to raise interest rates, but every time they raise rates, they see mortgage applications and refinance applications fall. So they're worried that if they raise rates too quickly, that people are going to stop going out to buy a home. The housing market has been fueling our economic growth because that's one of the industries that has really been skyrocketing. And yeah, people are going back to work and people are starting to make money and people are starting to spend money, but we still have a lot of people out there that aren't spending money on their mortgages because we have the mortgage forbearance program still going on, and we have the student loan forbearance program that's still going on. And so people have more money in their pockets that they can use to spend, and some people are using this money to go out and buy a home, which makes things very interesting because if we talk about mortgage rates, well, the Federal Reserve Bank wants to raise mortgage rates. They have said that time and time again, and they're working to raise mortgage rates, and their first priority is to raise mortgage rates as fast as possible, but at the same time, they don't want to destroy the housing market. And so the thing that the Fed is monitoring is once you start to see the economy recover besides just the housing market, chances are you're going to see mortgage rates start to really tick up. I mean, you've already seen mortgage rates start to come up quite a bit off of their lows. Now, mortgage rates today are still historically extremely low, but they're not as low as they once were. And so people are trying to take advantage of these low mortgage rates while they still can, which is why now you have a massive demand to buy a home and you don't have the same supply, which is causing home prices to shoot up. So when you put these three things together, you have a material shortage and a labor shortage. You have the supply and demand shift, and now on top of that, you have these very low mortgage rates. You essentially created this perfect storm where everybody wants to buy a home. Everybody's trying to take advantage of these low mortgage rates, and the cost to build a home is way up here, which is causing the price of homes to shoot up like this. Now, the question that everybody has about these housing prices is, are they sustainable? Well, let me start by talking about this. There's a big difference between a real estate crash and a real estate correction. And so when everybody thinks about home prices coming down, they assume real estate crash, because the last time we saw real estate correction was the 2008 housing market, and that was an all-out real estate collapse. And so just because we see a real estate correction does not mean we're going to see another 2008, but home prices have definitely heated up. And in order for them to be sustainable, there's going to be a lot of things that have to happen. The price of anything, I don't care if you're talking about real estate or stocks or cryptocurrency or gold or whatever, the price of anything depends on how many sellers there are and how many buyers there are. There's supply and demand. If you have a lot of people selling an asset, let's assume we're talking about homes. If you have a lot of people selling homes and no one buying homes, well, that's what we saw after the 2008 crash. Everybody was getting foreclosed on, everybody was trying to sell their home because they were underwater, and nobody had the money to buy, and so home prices came crashing down. Right now it's the exact opposite. Right now, a lot of people have some extra cash in the bank, and a lot of people want to go out and take advantage of these low mortgage rates, and a lot of people are not selling their homes. So you have a major demand to buy homes and a very little supply, which is pushing home prices up. And so in order to keep home prices up, you have to keep having more buyers. And so what you have to think is eventually we're going to hit a point that if home prices keep growing so quickly, we're going to hit a point where home prices are going to outprice buyers, because if mortgage rates start to go up and the cost of materials keep going up, then home prices are going to go up so high that people cannot afford to go out and buy a home. If we hit that point, then naturally you're going to have way less buyers out there, because buyers are going to say, well, it's way cheaper for me to rent. I can't afford a home anymore, so I'm just going to rent a home. Now people who are selling a home are going to say, well, we've had our home on market for 2 weeks, 4 weeks, 6 weeks, and we can't get a buyer. So now we have to cut our prices. And if you start to see that happen, now you'll start to see home prices start to correct. And in a normal market, this is how you start to see market equilibrium. You see an asset price go up too high, it has to correct, and it comes back down to earth, and then you'll start to see it go back up again. But sometimes you can see things get skewed. Like right now, we have a lot of things getting skewed because of government intervention. People don't have to pay the mortgages, they don't have to pay the student loans, people are not getting foreclosed on. And so you have a lot of people who want to buy a home and a very short supply of homes available for sale, which is keeping the housing market artificially inflated. And so when you start to see these things come back, then our housing market is going to rely on the strength of our economy. If our economy continues to stay strong, if wages continue to go up, and if people can continue to qualify for a mortgage, and people keep buying a home, then you can continue to see home prices go up. But if people cannot afford a home, and if because of this new inflation, people can't afford their cost of living, and so they want to downsize, then you might see more people selling a home and not as many people buying. This is where I want you to understand that it is very difficult to predict the economy. It is very difficult to predict the market. Nobody knows what's going to happen. Nobody knows when we're going to see a real estate crash, and nobody knows how big it's going to be when it happens. So what I want you to understand is, instead of living in fear and in living in emotions, I want you to make smart decisions today. If you want to go out and buy a home or refinance on your mortgage, make sure you can afford it. So if you're going out to buy a home, make sure you can afford the down payment and make sure you can afford your monthly payments. So what I mean by affording the down payment is I want you to have equity in your property, because if home prices go down, I don't want you to be underwater on your homes. So you want to have equity in your property. Ideally, you want to have 20% down when you go out to buy a home. I know that's a lot of cash, but then you know that you're actually affording your home and you have skin in the game. So even if home prices do come down a little bit, you're not underwater. You also want to make sure that you can afford your monthly payment. The advantage that we have now that we didn't have before the 2008 real estate crash is that back before the 2008 crash, you had so many people on variable interest rate mortgages. So back then, when mortgage rates started to go up, people's payments started to skyrocket. Now you have a lot of people on fixed rate mortgages. So even if interest rates go up, or I should say when interest rates go up, people's payments will not go up, assuming that you have a fixed rate mortgage. And so the worry is that as mortgage rates go up, you might see more and more people start to kind of go towards variable interest rate mortgages. That way they can get that low teaser rate again. But I want you to be smart here. Make sure you can afford your mortgage payments and lock in your payments. Whether you're getting a 30-year or a 15-year mortgage, lock it in with a fixed rate mortgage. If you have a fixed rate mortgage, you know what your payments are going to be in 5 years and 30 years. And the hope, let's assume that you live in this home for 30 years, is in 30 years, your wages are going to go up too, but your mortgage payments are flat. Your mortgage payment is not going to go up, but the amount of money you're making will go up. So this is where I want you to be smart. If you're going to go out and buy a home, just make sure you can afford the home and that it doesn't stretch yourself too thin. And if you're going to afford it, make sure you can afford the down payment and your monthly mortgage payment. So if you can cover these two things, you're okay. You don't got to worry about what's going to happen in the housing market because you can afford the home that you're living in. If you're refinancing a mortgage, make sure you're refinancing the right way. Don't just pull out a whole bunch of cash out of your home, then we can go out and buy a boat or go on vacation. These things are liabilities, and now you're financing your expensive lifestyle. If you're going to refinance your home, make sure you do it the right way, in a way that's going to build you wealth. Pull out just as much money as you need to pay off your first mortgage, or if you want to pull out more money, make sure you have a place to put this money. Maybe it's an investment, maybe you're starting a business, maybe it's a rental property. Just make sure you understand what you're doing and make sure you understand the risks associated with taking on any more debt. If you enjoyed this video, here's a video on how to start generating passive income that I think you'll love. And while you're at it, download a free money management PDF. And as always, keep hustling. One of the biggest lies out there about passive income is that you need a ton of money to start generating passive income. Yeah, the more money you have, the more passive income that you can generate, but you don't need a ton of money to start generating passive income.